Hello, and thank you for joining us today. My name is Anastasia Papas, and I'm the founder of the e-Access Forum. Today's webinar is the second we are organizing in collaboration with the European Banking Institute. The first webinar was in November, and the panelists included central bankers from the ECB, the Bank of England, and the Swiss National Bank. The discussion focused on the results of the climate stress test and exploratory exercise that these three central banks had conducted. You can find the video of this webinar on our website. Today, on the other hand, the discussion will focus on what these findings from these climate stress tests imply for the regulatory capital framework of banks. The panelists are Steve Cecchetti, who is the Rosen Family Chair in International Finance at the Brandeis International Business School. Steve is also the Vice Chair of the Advisory Scientific Committee of the European Systemic Risk Board. Pierre Monnin, who is a Senior Fellow at the Council on Economic Policies and visiting professor in practice at the Gratham Research Institute at LSE. And David Ramos Muñoz, Professor of Commercial Law at Universidad Carlos III in Madrid, where he directs several research projects on finance and climate change. We will start with three short presentations, after which the panelists will answer your questions. So please post the questions on the Q&A function. So let me pass the floor to Pierre, who was also the moderator of the November webinar. Pierre?
Thank you very much, Anastasia. Can you hear me well?
Yes.
So I'm going to share my screen when I can. Yes. So in my introductory remark, I would like to speak about climate stress tests and how they can be used in macroprudential policies. The topic of today is also a lot about capital requirements. So big part of macroprudential policy relies also on capital requirement, and I will make the link there. But before jumping into climate stress tests in particular, I just want to quickly go through what are stress tests in general and how they are used in prudential regulation, micro and macroprudential regulation. So since the last financial crisis, or the previous financial crisis, since we are kind of living one now, central banks and supervisors have implemented stress tests as a very important tool to assess the resilience of the financial sector. And these stress tests basically are made of three components. So the first one is a severe macroeconomic command shock. So the idea is to see how the financial sectors is resilient to, let's say, severe macroeconomic shocks that affect all the bank or big part of the banking system. So this is the macro part of the stress test. And then an also very important part of stress tests in general is how these initial shocks or outside shocks are amplified by the financial system itself. So there are several ways of amplification, several mechanisms of how this risk can amplify and become systemic. And this is also a very important part of the design of the stress test. And the last part of stress test is to look at what we call tail risk. So stress tests are not about, forecast about the middle of the projection of the shocks. It's really to see what happens at the end of the distribution. So where shocks are very severe and very, let's say, with a low probability to happen, but with large damages. So that's how stress tests are used in general, are designed in general. And they are used by supervisors first and foremost as a diagnostic tool. So the idea here is to have a sense of where are the sources of risk, where are the vulnerability of the financial sectors, of the financial sector, and it's basically a tool to analyze financial stability and weaknesses of financial and banking sectors. Stress tests are also used sometimes for calibration of prudential policy tools like capital requirement. We can think about countercyclical buffers, for example, but this is not the main application of these tools, but they are sometimes used as a calibration tool as well. So now, what about climate stress test? So I can only recommend you to read the papers that I highlighted here, which is the lessons and findings that the FSB and the NGFS have drawn from all the climate stress tests that have been done internationally. And I think the first remark that we should highlight is that they are probably never called climate stress test. It's climate scenario analysis. And I will come back on that. So far, I think that climate stress tests are not really stress tests. So central banks around the world and supervisors around the world have started to do climate analysis or climate stress tests, but they've done that for multiple reasons. So, and these multiple reasons, in particular, to develop also their understanding and their capabilities of analyzing climate shocks, to engage with the industry, to develop the capabilities of the financial industry, to look at how climate change and the transition can affect the macroeconomy. So they've done that for all reasons, but also with a goal to assess how climate risk could impact financial stability, so the macroprudential part, and to assess how climate risk could impact individual financial institutions, the micropru part. And this is what I will focus in my remark at the end. So the next, as I said, usually central banks and supervisors call them exploratory scenarios or scenario analysis, and I really think that currently how they are done, stress tests are not really stress tests. Climate stress tests are not stress tests for several reasons. First, the macro model on which they are based do not simulate or predict severe macroeconomic shocks. So the climate shocks, as they are simulated now, unwind over a long period, and they are based on macro models that are usually based on general equilibrium mechanism, where everything goes smoothly and agents adapt smoothly, and they not compound or with other economic shocks. And supervisors usually look at one trigger of shocks, like the introduction of carbon price. So I think that to be very stressful in terms of macroeconomy, we should also look at scenarios where the realization of a shock happens over a much shorter period than the 10 or 20 years that is usually taken. We should also introduce mechanism where agents adapt not smoothly, but where there are possibility of disruptive and chaotic adaptation. And also where triggers of the shocks, like a change in agents' preferences, a change in technology, and a change in policies happen at the same time together to trigger sizable shocks. So that's some suggestions that I have to make the macro part of stress test more a stress test. And then I think there are two things that are very important in stress tests is how they are amplified through the financial sectors. So there are initial studies that shows that there are second round effects with climate change. So this is a study by Battisto and others that shows that actually second round effect through the interbank market are not insignificant. Like if you would look at only the initial shock, then in their assessment, Deutsche Bank would be the most hardly hit by a first shock, and a bank like Crédit Industriel would not be affected at all. But then when you compute all the interbank relationship and exposures that you have, then or something like a bank like Crédit Agricole would be also badly hit, but only through second round effects. So so far there are very few climate stress tests that have this second round effect through interbank exposure, and this should be added. And then a second, I think, systemic amplification mechanism that is not really taken into account into current stress test is the possibility of a sharp and sudden market price correction. So usually in stress tests, you have scenarios where prices, or market prices, stock prices or bond prices move a lot. And I think this possibility is usually underestimated in climate stress tests so far, but there is a potential for sudden market price correction. And this potential exists because there is actually now a strong consensus that climate risks are not fully reflected in asset prices. So when you ask market participants, they usually share this claim, and this is also highlighted by the FSB, the IMF, the BIF, or the ECB. So there is a potential misalignment of current prices. There is also a strong consensus in the US recently starting to emerge, but especially in Europe, that financial institutions do not manage climate risk adequately now. So if they don't manage climate risk adequately, we can have some doubt that prices are fully reflecting all climate risk. And I think that when people start realizing that, for example, after an initial shock, then there is a potential of strongly revising expectation. So suddenly pricing in all these risks that are not priced in now, which can lead to sharp and sudden price correction. And I think that should be also included in stress tests. So in a nutshell, how can we use climate stress tests so far in macroprudential policy? I think there are useful conclusions, especially from the studies that I showed you in the beginning. First, the current climate stress test significantly underestimate climate systemic risk. This is word for word what is said by the FSB and GFS. So we are still at the beginning of developing climate stress test, and so far the result that we have is a lower bound. Another useful conclusion from stress test is not about the numbers, but about the ranking of the scenarios. And I think all studies that I've seen so far show that an orderly transition is the best scenario for financial stability. The worst one is when there is no transition and a lot of physical risk. So from a financial stability perspective, financial supervisors have an interest in seeing the transition happening. Now, can we use and calibrate capital requirement, whether it is at the micro level or the macro level on the stress tests? So far, I would say no. No in terms of numbers. So it's useful to do stress tests. They give information about the weaknesses and the structure, for example, which scenario is the best. But I don't think that we can actually use the numbers to calibrate macroprudential policy. I'm not saying that we should not use macroprudential policy, but I think something that would be wrong is to say the climate stress tests now show no significant costs, so we should have macro capital requirement of 0. Because the current numbers that we have are underestimating the risk. And I think the result of the stress test, especially the fact that the orderly transition is the best scenario for financial stability, support the view of a proactive macroprudential policy. So if financial stability is best, is best safeguarded in an orderly transition, I think there is an interest for regulators and supervisors to proactively to use macroprudential policy to support the transition and therefore reduce risk for financial stability in the future. This is what I call a proactive macroprudential policy, but I'm happy to be more precise later if there are questions on that. Thank you very much.
Thank you very much, Pierre. Steve, the floor is yours.
Thank you very much. Let me try and expand a bit on a few of Pierre's themes. So first of all, I would talk about instead of stress tests, I think we should talk about financial system resilience and the potential role of climate in ensuring that resilience. If I look and ask where are the main challenges that we face, a big challenge is that financial stress arises suddenly and unpredictably. Climate change is gradual and to a large extent predictable. So if I quote from John Cochrane, with whom I agree occasionally, on this I definitely agree, and that is banks did not fail in 2008 because they bet on radios, not TV. In the 1920s, banks failed over mortgage investments that they made in 2006. So the issue here is whether or not climate-related events that are gradual and largely predictable are going to create financial stress. They may, but that's not what a stress test is about. A stress test is about something that occurs suddenly. So if we confront that challenge, the first thing is just to make sure that supervisors insist that intermediaries do what ECB Executive Board Frank Elderson described late last year as identify, assess, control, and mitigate the inevitable risks arising from climate and environmental crises. One of the important word in this statement is actually inevitable. And so I think that means that stress tests are largely not the right tool for dealing with something like this. So what is a climate stress test scenario? First of all, let me just say very quickly that my view of stress tests is that they're the ultimate macroprudential tool because they're supposed to be severe and they're supposed to be flexible, but they ask, what is it that all of the banks or the financial intermediaries of the system, what happens to all of them if they're not allowed to change their balance sheets at all? Of course, there can't be any. So this means that because in real life they would be changing their balance sheets, as Pierre mentioned, there would be second order effects. The solution to this in the actual stress test world is to make sure that the scenarios are in fact much more severe than anything that you would ever see, because that will, if the banks can withstand those very severe scenarios, then there will be no second round effects. So, but here the question is, what about a sudden large movement in climate-related asset prices? That's the thing that I would worry about. Now, if you formulate a stress test, then what you have to think about is that there's a distribution of possible outcomes. There are perceptions, importantly, perceptions of the frequency and severity of those risks. Changes in investor perceptions about the future have an impact on asset prices, and these things can be abrupt. So what we're looking for is large abrupt changes in perceptions about the distribution of the severity of climate-related outcomes, and those things can create risks. So what I want to point out is that then we can actually measure something like this. We have tools existing right now to use market prices to measure the impact on banks of large changes in asset prices associated with climate. there's daily data on something called the stranded asset portfolio. And what we can do is we can use an adaptation of a procedure that's been pioneered by the NYU Stern School Volatility Lab and Rob Engel and his colleagues, that is based on something called S-risk, which stands for systemic risk, which is the capital shortfall associated with a 40% global equity market decline. We can ask a similar thing about climate, about the capital shortfall associated with a 50% decline in the value of stranded assets. And we can look at this using equity prices of publicly traded banks. And here's some results for some big banks in the United States, for which they've done the calculation fairly clearly. I have US data. There are data for other countries and for other banking systems, but the results are just not huge. Now, what I want you to focus on here is that largely this climate risk for most of these is actually negative. They actually benefit from the stranded asset portfolio's decline. So they're not facing these banks, of which there are 10, and they're quite large, some of them. Some of them are primarily asset managers or insurance companies. They really don't face large climate-related risks in their portfolios as it stands. Now, it turns out that they face enormous systemic risk associated with general economic activity. That's the tan part of this, but the red part is very, very small. Now, many of them actually have what I refer to here, or several of them, as baseline fragilities, especially Citigroup. Those are the deviations from 8% capital requirements that they face without anything at all. If I can do something similar for the entire US banking system, it turns out, where the red part is the C-risk exposure that they face. It can grow to be quite large across the banking system or the financial system as a whole. And the reason for that is that insurance companies face big risks associated with this. But insurance companies tend to have enormous capital buffers. And so in the end, these things really aren't that big a deal. So if we look at this, though, I would say that we want to think about then what is it that's causing C-risk to change. You have changes in the distribution that I talked about, changes in the uncertainty itself, but there also are triggers. So if you look, we've done some calculations based on things like the Camp Fire in California and whether that changed the level of C-risk even for banks and financial intermediaries that were not directly exposed. And the answer is yes. And that's because the perceived increase in the frequency and severity of climate events changes asset prices. But in the end, the magnitudes of these things are swamped by more structural shortfalls that are associated with other things. And so in the end, I conclude that, first of all, should supervisors insist that banks manage climate risk? Well, yes, obviously they should. I view a lot of what people are saying as just telling the risk managers in the financial system to do their jobs. Can climate-related events create financial instability? In principle, they can, but it doesn't look like they're very, those risks are all that large because are climate stress tests actually worth the cost? These are very expensive things to do, generating these scenarios and then getting the banks to do this. I would use market-based information. Using market-based information, the answer is probably no. I should emphasize that the technology that I was showing you a moment ago has been compared to the outcome of actual supervisory stress tests of the standard type, and they are very, very similar. So my answer is that this is not where we should be looking for financial instability. Now, can we separate climate and financial instability policy then? I think the answer to that is probably yes. So I look forward to the discussion. Thank you very much.
Thank you very much, Steve. David, floor is yours now.
Thank you very much, Anastasia. I'm gonna go very quickly because I have far too many slides, and what I really want to do is to focus on 3 or 4 main ideas. So a stress test, climate stress test, or any other kind of stress test is an exercise in modeling, but at the same time, it is also institutionally based, and that has to be understood. It is based on a legal framework. That means that we need to bear in mind three ideas. One is that the authorities that conduct the stress test or climate stress test or scenario analysis have to justify what legal source they are using for that. In second place, they have to determine what consequences can be drawn from this. And in third place, we also need to bear in mind, and because this is something that financial authorities, supervisors typically have very much in mind the possibility that a court may review and potentially annul the decisions, not necessarily of conducting the stress test, but of any consequences that are drawn from that stress test. So those three ideas, justification, consequences, and potential court review, have to be kept in mind. I'm going to skip through this just to focus on some relevant legal provisions in the European Union that talk about different types of stress tests. So for starters, a stress test is something that can have different legal sources and different purposes. It can be conducted by the bank itself. It can be conducted by the supervisor. It can be conducted for different purposes, most notably, at least in the European Union, as part of the supervisory review and evaluation process, which is typically the one that the ECB and other supervisors use for Pillar 2 measures. And that has to be distinguished from the institutions, the stress test by the institutions themselves. So that influences the presentation or the justification of the stress test, of the exercise itself, which is instrumental to later determine what are the consequences to be drawn from it. This is just a very brief summary of the equivalent in the United States. Stress tests have been amended after the Dodd-Frank Act, and they have eventually the quantitative evaluation, for example, has been incorporated in the stress capital buffer, just to give you an example. So the justification of the stress test and the consequences of the stress test are different because, for example, in the EU, the consequences, Pillar 2 capital requirements. In the United States are restrictions on distributions. Those are quite different things. And that means that if we only take those two examples, we see that the justification and the consequences are different, and therefore the institutional significance of a stress test or a scenario analysis is also different. So when we go to the third point, which is how courts may review this, we look in the European Union, for example, the criterion that they use for this typically is that a stress test would be what is called a complex economic assessment, which is granted a certain amount of deference by the courts. And the court review is based on manifest error of assessment. However, there are other issues that are problematic in the way that stress tests may be conducted, especially if they result in additional capital requirements. One, the banks may allege that the institutions are overstepping their mandate. They are exercising broad discretion. Two, the courts may decide to conduct a thorough review of the facts employed by the supervisory authority to justify the consequence drawn from the stress test. And then they will clearly scrutinize the statement of reasons and conduct a proportionality analysis. So having these three things in mind, justification, consequences, and potential court review, how do authorities represent climate stress tests? Here I link with some point that Pierre made before. Most authorities, it is true, they do not present these as climate stress tests as stress tests. The Federal Reserve Board, for example, called it pilot climate scenario analysis exercise, and it used a language to, as much as possible, tone it down the potential consequences. I have highlighted some paragraphs here. publishing insights gained from the pilot at an aggregate level, no firm-specific information. It is distinct and separate from bank stress tests, just to give you an idea. The Bank of England PRA used a relatively similar approach. And those that are a little bit more daring include the European Banking Authority, but still they differentiate between their stress testing and their pilot exercise on climate risk. So they conduct it as two separate processes. The only example where we can find that there is a sort of coalescence of the stress test approach and the climate scenario analysis is the case of the ECB, where we can find references in the guidelines on climate change and environmental risk as part of supervisory expectations, where a specific mention of the need for banks to conduct their own stress tests, and then in the reports published and the climate stress test conducted in 2022, an explicit reference to the fact that in the understanding of the ECB, this scenario analysis forms part of the same logic as climate stress tests. This is a supervisory logic, so a pillar 2 logic. And this is the way that it is gradually increasing the precision of the stress test, in the understanding that in the future it may lead to additional capital requirements in the form of pillar 2. It is not there yet, but it is justifying this in this way. So once we have this, the question is, if it comes to that, if it comes to additional capital requirements, where would the match be played in case the courts had to review the results of the stress test in the form of additional capital requirements? The questions that would be asked by the courts would be typically, does scenario design and analysis entail broad discretion? This would be problematic for the EBA, which is an agency, not so much for the ECB, which is a treaty institution. Are the scenarios plausible? Plausibility is the test used by the courts to revise when a supervisory authority has committed a manifest error. Are the consequences proportionate to the objective sought? This would be a bit tricky. And are climate stress tests being used in a way that goes beyond the legal basis used by the institution? This would be perhaps, in my view, the most interesting point of the discussion. In the United States, the discussion at a court level, if stress tests, climate stress tests were used for purposes of additional capital requirements, there would be arguments on separation of powers and delegation, in the sense that has the Federal Reserve Board been entrusted by Congress with the authority to adopt these sort of measures? And it depends on how bold and significant they are perceived by the courts. 2, have the rules of the Federal Reserve Board followed notice and comment? This would be a procedural objection typically of courts in the United States. And others, but this is a big question mark, would be whether the agencies, or in this case, the Federal Reserve Board, may have conducted a cost-benefit analysis. I'm saying this because cost-benefit analysis has formed part of the so-called arbitrary and capricious test of the Administrative Procedure Act when reviewing acts by an administrative authority. So there is there is a lot of food for thought what this provides, but I stick to the 3 initial points. From an institutional or legal perspective, it is not only relevant whether a stress test is well conducted, whether it is realistic or not, but how is it justified from a legal perspective? 2, what are the consequences that are drawn from it? And 3, how courts will perceive it, even beyond how the authority perceives it, how courts will look at the stress test to determine whether the consequences drawn from it stand or are quashed by the courts. Thank you very much.
you very much, David. We can answer your questions now. There's already one question, and this is for you, Steve. Can you please explain the mechanism by which some banks are supposed to benefit from 50% loss in value of climate-related standard assets? And how does the modeling you've presented considers physical impacts of unmitigated climate change, including potential catastrophic and irreversible events like polar ice sheets collapsing?
So I think that this is a very simple procedure, and all I'm reporting really are the betas. So the idea here is that the climate beta for banks seems to be negative, which is to say that the banks, that when the value of the stranded asset portfolio falls, the correlation of bank equity returns is negative. So it goes up. So there's an increase in the value of the bank from the drop that is coming at the same time as that drop. This is not a mechanism in the standard sense. It's a standard. What it's telling you though is that markets believe that banks benefit from stranded asset portfolio value declines. This doesn't tell you anything about physical impacts of anything. But my main point is that things like the physical impact of unmitigated climate change does not create sudden asset price movements, and is not the sort of thing that would create financial stress, which is, as we saw recently, financial stress arises because something happens from one day to the next. Climate-related risk sometimes materializes and causes people to change their perceptions from one day to the next. But the descriptions of most of the catastrophes that we're talking about here, I think, are playing out rather slowly.
Thank you. Another question for Steve.
I think Pierre wants to say something about this.
Oh, sure. Sorry.
Sorry, just to clarify. So when you talk about stranded assets, you talk about transition risk or some of the transition risk. So it's only a partial view of transition risk. I think what climate stress tests or climate scenarios have shown so far is also a ranking about the different scenarios. So what the ECB, for example, highlight is not that what they highlight is that a transition that happens gradually, orderly, and very early. That's not particularly the most threatening scenarios for the banking sector in general. So you also, but they show that, for example, the no transition would lead to much more, for example, probability of default, a higher probability of default. So there is this ranking which is very interesting from climate change when you look at not only transition but also other risks. And I agree that what triggers stress is large movement in assets. But I think that's not the only. That's one of the triggers. That's one of the trigger. What we have seen also is that if one bank, for example, is having troubles, that can cascade into more losses in the rest of the banking sector. So if, for example, there is, let's say, a natural catastrophe that put one bank more at risk, that could also be a trigger. So it's not only asset revaluation. So Steve has presented something for equity. There is also all the loan portfolio or the bond portfolio that should be looked at, and all this, reinforcing mechanism that could be triggered.
So I think we're going to have to disagree.
Yeah,
I think that's wrong. So the reason is that what happened recently is triggered problems for banks that looked the same as the bank that had the problem. So you're right that if one bank has a problem because there's a lot of default, because, you know, Miami Beach is flooded or something like that, other banks that are exposed to Miami Beach will then have problems. Okay, but that's
all banks that are exposed to flood in California.
No, well,
No,
only
that's-
but again, it's banks that are exposed. It's because there's a change in the perception of the distribution of possible outcomes. Now, one of the things that you may be pointing out, which I agree with, is that it might be a perception of the timing. But again, most banks' assets and loans are relatively short term, certainly relative to what we're looking at here. And default risk that is arising right now, which is quite substantial, is default risk that's arising not from climate, but from something else. I mean, I think that the system is quite fragile right now, but the system is fragile because commercial real estate lending is a problem. It's not fragile because people have said, oh, there's going to be, it's more likely that there's going to be climate change. So I think that I really think this is sort of on the wrong track, but it's not on the wrong track to see that people need to care about it. It's on the wrong track to say that this is a financial stability risk. It's not a financial stability risk.
Okay, so the next question has two parts, and I will mention the second one for Steve, and then the first one any of you can answer. Steve, the question is why Morgan has such a large negative C-risk number? Could it be that they're shorting brown industries?
I have no idea.
Okay, that was quick.
I just report what people. I haven't read their disclosures. I read SVB's disclosures, but not Morgan. So I don't know.
So the first part of the question is, whether the disclosure from insurance companies and banks of their climate-related risks is sufficient. And to this, I would like to add the fact that the ECB stress test or scenario analysis exercise did show that very few banks were allocating voluntarily capital for climate risks, which is why, quite a few of economists in Europe are advocating that climate risks need to be reflected in minimum capital requirements, Pillar 1. So I think I will ask Pierre to answer this question.
So I think we can think of a capital requirement in two ways. The natural way of seeing capital requirement is a buffer to absorb losses and shocks. And here we can agree or disagree with Stephen saying that it's not a threat. I'm just for the sake of clarity also quoting the FSB and the ECB that are highlighting that as a potential source of financial instability. So I think the answer is not as clear as that. One thing that I think climate stress tests really show is that for financial stability reason, the transition, an orderly and early transition, that's the best scenario. That's the scenario that is minimizing the risk for financial stability. So as I kind of said it in my presentation, in that sense, a supervisor that has a mandate of financial stability has an interest in seeing an early and orderly transition happening. Now, if you want to fulfill that mandate, capital requirement could be used to give incentives for this transition. So this is something that is usually supervisors would reject, saying that capital requirement is only there to absorb losses. But if your goal is to preserve financial stability in the long term, and you know that an orderly transition is the best way to minimize the risk for financial stability, from a prudential perspective, you could also agree that you could use, or you could also argue that you could use incentives through capital requirements to support this transition and thus minimize financial stability in the future. So this is something that is discussed here, and I think it's still an open question. David, want to add?
Yeah.
Thank you. I think that in terms of the disclosure requirements, the answer, I think it's generally agreed that this level of disclosure is insufficient, and this is, for example, why the European Banking Authority has already published the implemented technical standards for Pillar 3 disclosures on climate-related and environmental risk, which provides for a more specific approach as to the different elements that can influence the climate-related risk that a bank is exposed to. So one of the regular objections to going further into assimilating climate risk into prudential requirements is the lack of data, but the lack of data can be ameliorated by better disclosures that clearly differentiate on the different types of exposures in the credit book and the markets book of the different banks. And this is what these standards are, for example, trying to achieve. So one of the things that you can observe, at least in the European Union, is that the whole disclosure infrastructure is being appended. So not just by Pillar 3, but also by other rules.
Thank you. Next question. The insurance sector is the most affected by climate change. What kind of regulations and public policies should we be thinking of, especially since the assumption is that insurance companies protect firms and banks from risk and therefore provide a positive externality? Who would like to answer this, Steve?
I think it's a complicated question, especially because keep in mind that insurance companies tend to renew or cancel policies on an annual basis. And so I think the bigger issue for me is that people have talked about things that they call an insurance gap that's arising as a consequence of climate policies, where insurance companies are canceling certain kinds of policies because of the fact that there are increased climate risks, and that this is leaving a gap. I think what this means is that as a society, we need to decide how we're going to provide insurance and the transfer. So there are going to be big losses. This is a separate issue, I think, and it is a bit related to questions about whether or not how you want to set capital requirements. But I'm going to put that off to one side. The thing is that the society is going to suffer costs from mitigation and costs associated with climate-related events, and the question is, how and who is going to pay for these? And I think that we have to discuss a way of distributing those costs because they're not privately insurable largely. And so I think that this I think is, if you ask me what's sort of one of the biggest issues here and what's stopping us from actually doing what we need to do, it's the fact that we haven't figured out how to distribute the cost of paying for it. We're better at distributing the cost of paying for disasters, where disasters occur and everybody says, "Oh, I feel really sorry for those people. What if it were me?" And then we spread the burden. But we're bad at the ex ante stuff, and that's what we need to do. So I'd say it's a social problem rather than a private problem.
Next question. Pierre, can you please explain what the first and second round effects meant, and why Deutsche Bank had highest value in first round, and with which factors were taken into account in the calculation?
So this is numbers that I took from a study in I think Nature Climate Change by Battiston and others. it's an early study about second world effect, as far as I remember. So when Deutsche Bank has a lot of first round effect, is that when there is, so for example, Deutsche Bank is giving loans or has a lot of assets in sectors that are exposed to transition risk. As far as I remember, that's what the study is about. So it means that they are directly giving loans or buying assets in sectors that are exposed to transition risk. So if these risks realize, they will lose directly. Now, Société Générale, which is a second one, has apparently, and I'm just interpreting the numbers that I've seen, I didn't compute them myself. They don't have this direct exposure, but they might be exposed to Deutsche Bank indirectly. So if there is a problem at Deutsche Bank, then their assets are also at risk, and that's what we see in the second round effect. So if you look at the exposure of Société Générale, for example, to the let's say the coal industry, which is at transition risk, they don't have a lot of exposure there, but they would be hit by realization of transition risk through the cross exposures that they have with other banks that are exposed in the first round. And then you can compute that with several rounds. And that's how basically cost could spread. So I hope, I didn't write the study and I read it some time ago. I hope it's the right interpretation of their results. And apologies if it's not in advance.
David.
Yeah, just to reinforce the point that Pierre was making. So one of the in the more comprehensive study that climate scenario analysis that has been conducted, which is the ECP one of the issues that where they are still not there, they acknowledge that, they are pretty candid about this, is that of second round effect. So and that has to do with the network connectivity of the financial system. So you may have a shock that wipes out some institutions, but you have to think about which institutions in turn are exposed to the institutions that receive the first round effects. And that's something that, for example, is not yet computed into these models. And that could be a further source of not only of complexity, but also of potential risk. Generally, in network equilibrium models, the results that are normally yield that there is a tendency to over-connect, since there is no specific knowledge of which is the exposure to large shocks of the entities that I am exposed to. So that's I suppose the difficulty of this exercise.
Steve?
Yeah, I'm extremely pessimistic about the ability to do these second and third and fourth round effects, but I think that there's a simple solution. And the reason is exactly what David just said, which is that actually mapping the network and figuring out the strength of the connections is extremely hard. But if instead you ask yourself, if I have a very, very severe shock, more severe than anything in the historical record, and if everybody can survive without failure and without having to change their assets or their liabilities, then that means there will be no second round effects, right? And so I think that our goal should be to set up stress tests that don't require that we have the knowledge of the network. The network is changing all the time. I just want to be clear that I agree completely with Pierre's point that if you're not going to do the severe enough test, that you have to do something about the network analysis and the second round effects. But if you find your way to doing a severe test, which may not meet, David, may not meet your legal test, and this is an important point, because it's going to be something that nobody has ever seen. And can I then justify the proportionality of something that has never actually happened? I don't know. But I think that's the solution that we could be thinking about.
So the BIS published recently a paper suggesting caution, especially when implementing macroprudential policies, because they can, at this point, aggravate the or increase the transition risk. Yet all three of you agreed that climate change can lead to financial instability. Pierre argued for proactive macroprudential policies. How do we reconcile this with what the BIS is suggesting?
So I think that it's a question of the horizon you're looking at. So my proactive prudential policy suggestion is to think about financial stability in the medium to long term. So once the transition has happened in an orderly transition, then that's the best end up situation for financial stability. And this has been shown by several central banks. So that's the end goal. Now, if you want to use macroprudential policy, then of course you trigger a transition, and this is the realization of transition risk. And this is in fact triggering the realization of a risk, which could be a source of financial instability. Now, I think that what central banks have also shown, and what they are convinced, is that an orderly transition triggered by different policies, whether it is a carbon price or other things, is not something that is manageable. So they all highlight that an early and orderly transition, even if it entails transition risk, this is still risks that are manageable, and will not bring the system to the brink of a collapse, basically. So, yeah, in the short term, you might trigger some transition risk. In the long run, you're in a better position, and the short-term transition risk are apparently manageable. And that's also what Stephen results are showing about transition.
David?
Yeah, just to complement what Pierre just said, there are ways that that the measures can be made to more, you could say, it's less harsh to pilot the transition. So generally, the distinction is between green and brown, but the key is in managing the yellow to green transition, because if you just make a very stark distinction between green assets and brown assets, then what will happen is that much of that funding for brown assets will migrate outside the banking sector to shadow banking or something similar. If, on the other hand, you somehow account for the fact that in some cases, some loan portfolios or asset portfolios may be yellow but greening somehow, so you can help banks fund the transition to greenness to the companies they fund, and if you acknowledge that, then that's the best way that you minimize transition risk, and you don't turn prudential policy into an instrument of transition risk, but rather than a way to mitigate that.
Right, great. I think we have time for one last question. If regulators develop clear green, brown, and transition finance taxonomy, will prudential regulatory tools such as exposure limits be considered in the future? Who would like to answer this?
I can give it a start. So exposure limits are one tool that is considered by, for example, the ECB or the SRB. And the reason for that is that the result that they have show that some of the transition risks are concentrated in some sectors and some banks. So a natural way when you have a concentration of risk in some banks is to use concentration limits. Now, I don't think that taxonomy is the right way to do that. As David rightly highlighted, what we need is to basically, some firms can be brown now, but if they invest in the transition, if they have a plan for a transition, a credible plan, then you should support this transition and you should not cut funding there. So for me, the criteria is not green and brown now, is how engaged and credible they are in the transition. If you're not engaging in the transition, then obviously you're exposed to a lot of transition risk.
David?
Yeah, I essentially agree. I think that taxonomy is very useful if you want to foster the market in green assets. Mostly, that's the main use that it has been has been given. But creating a taxonomy of brown would be much trickier, much more politically sensitive, and there is no guarantee that it would be very risk-based, so that it would offer the kind of precision in calculating risk that banks need. So that's the difficulty. So I presume or I envisage that the use of the taxonomies will be to focus on the type of green investments, and then leaving the prudential tools to manage more or less the transition from brown to yellow, from yellow to green, and so on, as the models improve and the data becomes better.
I just want to add one quick thing. I know we're out of time, but I think that we have to be very careful with taxonomies, and we have to be very careful with the use of strict things like risk weights or concentration limits, because they risk actually, I think, as David and Pierre both said or implied, that that you'll end up with perverse effects. You could end up with people actually doing more of the things you don't want them to do, just outside of the perimeter of where you're trying to control it. So you have to be extremely careful with this. And just to give one clear example, I don't think that any of us want a system that encourages British Petroleum, which has a large green section and a large brown one, to split into two companies, one of them that's terrible and one of them that's good. What we want them to do is we want them to stay merged and to continue to try and become overall a carbon neutral company that is helping with the transition. But that example, I think, is one that we have to be very, very careful about, because on the financial system, this is going to happen quickly if you're not careful. People are going to actually just split off what they do and say, oh, you're going to let me do this over here cheaply, so I'm going to do it. And over here, I'm going to do the other stuff because you don't want me to do it inside of a bank or inside of a regulated entity. So I think that we have to be careful. And the taxonomy is the first step in creating that problem. So we have to worry about how we do that.
Great. So thank you, David, Pierre, and Steve, for great presentations. And thank you all for attending our webinar today. I think we have come to the end. Thanks again. Bye-bye.
Thank you. Bye-bye.
Thank you.
Thank you. Bye-bye.